Hello my fellow investors, and welcome back to another stock analysis video as well as earnings report. And today guys, we're going to be taking a look at the company Chevron. They just had earnings on Friday, and if you guys know me, then you probably know that this is one of my favorite companies out there because, well, this has been one of my biggest gainers ever since I bought them at around like 2020. Now, unfortunately, I didn't buy them at all-time lows, but I am making significant gains when it comes to this company from a dividend perspective as well as just capital gains in general. So let's take a look at these fundamentals as well as the earnings report and then see, using discounted free cash flow, what price we should buy this company at. And after the meteoric rise of oil, is it still a buy? Let's find out. So let's take a look at Seeking Alpha's earnings summary. We got EPS normalized actual came in at $4.09, which is a miss by 20 cents. EPS gap actual $3.33, missed by 89 cents. Revenue $56.47 billion, which was a beat, guys, by, take a look at this, $2.42 billion. Absolutely bonkers. So yes, they did miss on EPS, both GAAP and non-GAAP, but overall guys, that massive beat in revenue was insane. So let's come over here into the actual earnings report. And of course guys, like always, this will be linked in the description below if you guys would like to read it for yourselves. We got over here, Chevron announced its fourth quarter result. Fourth quarter earnings $6.4 billion, adjusted earnings of $7.9 billion, return on capital employed of 20.3% in 2022, record annual cash flow from operations of $49.6 billion, and free cash flow of $37.6 billion in 2022. Record annual US oil and gas production. Yeah, I mean, we all know that, right? Like, the main reason why all of this has happened when it came to Chevron is because of oil prices just shot up massively in 2022. And by the looks of it, as if I'm recording this, it is the 28th of January, guys. Oil prices are continuing to go up. So get ready for oil companies to possibly continue to rise if crude oil actually goes up again. Now, we got over here a couple of the summary. Let's read. Chevron Corporation today reported $6.4 billion in earnings, which was $3.33 per share diluted, fourth quarter of 2022. Compared to $5.1 billion, $2.63 per share diluted in 2021 fourth quarter. So right then and there, this is a perfect example that just because it misses analyst estimates doesn't mean that the company is losing money year over year, right? We just saw this right here, $6.4 billion in earnings this year. And then last year, it was $5.1 billion, guys. That is a massive, massive difference when it comes to these earnings. Goes on to read, included in the current quarter were $1.1 billion of international upstream write-off and impairment changes and pension settlements costs of $17 million. Foreign currency effects decreased earnings by $405 million. Adjusted earnings of $7.9 billion or $4.09 per share diluted in the fourth quarter of 2022 compared to the adjusted earnings of $4.9 billion, $2.56 per diluted share in fourth quarter 2021. So as you can see, even the adjusted still beat by a massive amount. Chevron reported full year earnings of $35.5 billion, which was $18.28 per share, compared to $15.6 billion, $8.14 per share diluted in 2021. Take a look at that, guys. More than double, 15.6 to $35.5 billion. Absolutely insane. And right here, we do get to see the summary when it comes to each of their segments. We can see that upstream was the biggest one out of both of them. In 2021, it was $5.16 billion, and then in 2022, it went up to $5.5 billion. And then in the year ended, it was double, 15.8 compared to 2021 and $30.3 billion in 2022. That was just the upstream. Downstream, it was a pretty big rise as well, $760 million in 2021 to $1.77 billion in 2022 for the 3 month, and then for the year they went from around $3 billion to $8.16 billion, guys. Absolutely crazy. The total in all was $1 billion change from 2021 to 2022. In the 3 month ended, going from 5.1 billion to 6.35 billion, and then on the year we went from 15.63 billion to 35.5 billion dollars. Absolutely insane. Now looking at what the CEO had to say, quote, "We delivered record earnings and cash flow in 2022 while increasing investments and growing U.S. production to a company record." Great, said Mike Wirth, Chevron's chairman and chief executive officer. The company's investments increased more than 75% from 2020. That's insane. So their investments are also growing by 75% since 2021. So since 2 years ago, or technically last year, because these earnings are for 2022. And annual U.S. production increased to 1.2 million barrels of oil equivalent per day, led by 16% growth on the Persian Basin unconventional production. Again, in 2022, we delivered on our financial priorities, returning cash to shareholders, thank you so much, investing capital efficiency, and paying down debt. Wirth continued, the company's other noteworthy financial highlights in 2022 were increased quarterly dividends per share by 6%, guys, from the prior year, paying out $11 billion to shareholders. Right then and there, just by doing nothing, you got, well, at least any person that holds this company, you just got a 6% raise in dividends. And we're going to take a look at this dividend because it's actually not that little either. Now, the yield is kind of, it's not as good as it was prior, but 6% still massive. Achieved return on capital employed of more than 20%, the highest since 2011. Strengthened its industry-leading balance sheet further with debt ratio of 12.8% and net debt ratio of 3.3%. Returned an additional $11.25 billion to shareholders, repurchasing nearly 70 million shares, ending the year at an annual repurchase rate of $15 billion. And by the way, this last point over here was awesome. They also just announced recently that the board also approved a new $75 billion repurchase program, guys. Oh my god. So that was really good to see. So not only are they increasing that dividend 6%, they're also buying back $75 billion worth of shares. And I'm going to show you the math as to what kind of percent this comes out to be. Obviously, that will change based off of what share price they buy it at, but nonetheless, we can make a rough estimate once we get into the calculator. So now let's actually come into the calculator and take a look at Chevron at a much bigger scale. We got the ticker for CVX, market cap of $347 billion, a PE of 10.21 with a current share price of $179.45. Now this is interesting because the PE of 10.21, guys, with the meteoric rise that they have had to a share price right now of $179 is insane to think about. The fact that the PE is telling us that this is still somewhat of a good price to buy it at. And if you guys don't believe me, take a look at this. On the 1 year, they're up 32.56%. On the year to date, they're up 3.14%. 52-week range, guys, is absolutely insane. $129.33 to $189.68. What? That's absolutely crazy. And in fact, before earnings came out, they were close to getting $190, I believe, like in a share price. And then the earnings came out, it missed, so they fell down, which is ridiculous, seeing that they beat revenue by $2.5 billion. So as you can see, they have had a massive swing when it comes to that share price. And by the way, it's not even that as impressive compared to how much they have risen even before the 1 year. Now, they do pay out a dividend of $6.04. Now, looking into this dividend a lot further, guys, their current yield, even after they increase this amount, their yield is 3.37%. So it is actually still really high overall. They do not have a payout ratio. The 5-year CAGR, it is 5.63% with a dividend growth of 35 consecutive years. So not dividend kings, but they are getting close to that kind of marker. Ex-dividend day is actually coming up on the 15th of February. So you guys still have about 2 weeks to get into this company if you so wish to do so. Payout day is on March 10th, and they do pay their dividends quarterly. And based off of the current shares outstanding, this comes out to be $11.7 billion being paid out in dividends every single year. And then as of their last year's free cash flow, after this is paid out, they're still left with $6.05 billion in free cash flow. And as of the last year's free cash flow, they're left with $24.14 billion. That isn't, guys, that's insane. That is an increase from the 5-year average to the last year's free cash flow of what, like 4 times? That's absolutely insane. These payout ratios, you can clearly see as of the last year's free cash flow, it is looking pretty, 32.61%. And as of the 5-year average free cash flow, it is high at almost 66%. So now let's actually come over here, guys, and analyze their fundamentals. Now, before we actually get into this, I can't stress this enough. When it comes to commodity-based companies, you have to take a look at them with a completely different light, because all of their earnings are going to be based off of that commodity that they are producing. In this case of Chevron, it would be crude oil. And even though crude oil has gone up recently, unlike the past, since like 2020, the fact of the matter is that, guys, if we take a look at this, yeah, before 2020, at around like January 1st of 2020, actually, crude oil went from a price of $61 all the way down to $18. And at one point, guys, it actually went negative. So at this point, you would think that all of their profits would go negative as well. And you actually do see that. And then after that, crude oil demand just skyrocketed, giving Chevron and any other upstream / downstream oil company that meteoric rise that oil has. So their profits may go down. However, you have to see as to why they went down. Is it because they're messing something up with the company, or is it just because the price of their commodity went down as well? So just make sure that you keep that in mind when taking a look at any commodity-based companies, and make sure to take a look at the futures for that specific commodity at that year when their earnings went down. So now with that said, let's come into the net income, guys. 5 years ago of $14.8 billion to 1 year ago of $34.2 billion, as an increase of 130%. They did go negative 3 years ago, but 3 years ago was 2020. Oil demand was collapsing. So that's not surprising. However, they did also go down 4 years ago too. Now we can actually see that correlation right here as well. Beginning at around like 2019, crude oil was not that high, guys. It was around like $50, $45, going as high as what we are right now at a peak of like $66 or so. But you can see that it remains somewhat stagnant. So the fact that oil prices remain stagnant for the good part of 2019, and then add on top of that all other expenses that the company is picking on just by existing, yeah, not surprising that 4 years ago they went down, still in the positive, but it did go down to almost $3 billion. But nonetheless, guys, I'm giving this a 55%, mainly because, well, I understand this 3 years ago, this 4 years ago, I don't like the fact that they did go down, but I fully understand why. And on top of that, 2 to 1 year ago, that is a very massive spike too. So 55%, I think, is very duly given. Looking at the free cash flow, it's pretty much like the exact same reason as the net income. 5 years ago of $16.8 billion to 1 year ago of $35.8 billion, increase of 113%, with an average of $17.7 billion. And again, we do see that small dip from 5 to 4 years ago, and then that massive dip from 4 to 3 years ago. The reason why I'm giving this a 60 is because, well, the margin from 2 years ago to 1 year ago isn't as big as it was from the net income in the same time period, so I'm giving this a 60%. Looking at the revenue, again, the exact same graph, just different numbers. 5 years ago of $159 billion to 1 year ago of $227.1 billion, increase of almost 43%. So the fact that we are seeing this once again 5 to 4 to 3 decreasing, but the margins here are a lot less, I'm giving this, guys, a 60%. Looking at the total assets minus total liabilities, unfortunately, this was not consistently increasing, and we do see the dip once again from 5 to 4 to 3 years ago. But you could see that even at the worst time 3 years ago, they were still in the positive by $133 billion, guys. And in the past 5 years, they've always been in the positive. And you can see that their average is at around like the $159 billion, like $150 billion or so. They are at least keeping it somewhat the same, which I like to see. Average total assets is $247 billion. Average liabilities doesn't even get to $100 billion, guys. $99.82 billion. Doing this difference, we get $147 billion. I'm giving this like an 80%. Looking now at the cash flow minus the liabilities, this one is actually really interesting because you could see from 5 to 4 to 2 to 1 year ago, this is almost like a perfectly linear graph, right? 81 billion, 79 billion, 78 billion, 64.3 billion dollars. The one outlier here is 3 years ago, but because of COVID, so it's perfectly understandable as to why their cash flow minus the liabilities went down severely. Their cash flow collapsed. Makes sense. So for that reason, this is actually looking like a really good graph outside the outlier. Therefore, I'm going to ignore it. Average cash flow minus the average total liabilities, we get negative $81.7 billion. And as of 1 year ago, we are significantly lower than that average. I'm giving this a 95%. Looking now, guys, at the shares outstanding. This one is interesting because they just announced, and I just showed all of you guys that they're buying back $75 billion worth of shares. So this is going to change a lot, especially now that they have announced this. Hopefully they're true to their word. But unfortunately, from this scale, we got 1.9 billion shares 5 years ago to today of 1.93 billion shares. That is a slight increase, but an increase nonetheless of 1.62%. And from the previous year to the prior year, they issued again around 0.1% of shares. Now you can see here that from 5 to 4 years ago, they did go down, going from 1.9 billion to 1.88 billion. But ever since COVID, they issued and then they kept issuing. However, it hasn't really been that big. That's why the fact that they just said we're buying back $75 billion worth of shares, I'm giving this, and the fact that they've only increased it by like 1.62 in the past 5 years. Think about that. There are much more blue chip companies that have issued a lot more shares in less amount of time. So for that reason, I'm giving this an 85%. And when it comes into the cash equivalents, they currently hold $15.2 billion with an average of $7.71 billion. Looking at the overall grades, guys, we give an net income of 55%, free cash flow 60%, revenue 60%, assets minus liabilities 80%, cash flow minus liabilities 95%, and shares outstanding of 85%. Overall grade of 68%. Right there, guys. I mean, we're 2% away. Honestly, they start buying back shares. This is already like above 70% at that point. They fix their net income, once again, above 70%. So they're right there. I absolutely adore this company. And, well, it's a reason why they are my best performer in my entire portfolio. So now let's see if at the current share price, is this company looking like a buy, even though they have risen a massive amount. So let's start off with a revenue growth, guys, of 3, 8, and 13%. My reason for this is Seeking Alpha's revenue growth is estimated at 8%. Now, the problem with this is that unfortunately, this is a little bit tricky because commodity companies follow the commodity that they produce. Therefore, oil could do who the hell knows. That's why I'm putting the revenue growth of 3, 8, and 13%. Really big, nice and wide kind of difference. So that way it encompasses all things that oil might do. If oil decides to go up back to like $120 per barrel, then the 13% might encompass that. And if it decides to fall, the 3% might encompass that, with 8% in the middle, which is what they're expecting. Now for the projected share buyback, I'm putting this at 12, 16, and 20%. Now you're all probably looking at those numbers and you're like, 20%? What? That's insane. So let's actually do some math as to where I'm actually getting these numbers. They just announced, guys, a $75 billion share buyback. At the current share price, guys, they're at 180. So I don't know when exactly they'll be buying back these shares or at what rate they'll be buying back these shares. Obviously, these numbers will change accordingly. But let's say that they buy $75 billion worth of Chevron stock at around like the $180. So we're going to put this, guys, at $180. So let's say $75 billion, which is 75 with 9 zeros. Then we're going to divide this by 180, which is the current share price. This is 417 million shares. Now, their current shares outstanding, as we saw, is 1.933 billion shares. So if we subtract 1933 minus 417, we get a total shares of 1.52 billion shares. Now, if we do the percent change of this, so if we do 1933 minus 1516, and then we get 417, and then we divide that by 1933, we get a 21% share buyback, guys. That's the reason why when it comes to these predicted share buybacks, I'm saying 20, 16, and 12%. Obviously, that 21% will differ based off of what share price you think they're gonna buy it at. I'm saying 180. If the share price goes down and they keep buying, guess what? It'll probably be more than 20%. So with these numbers and a required rate of return of 10%, this puts me at a target share price of $188.88 to $288.16. Absolutely massive. Now, adjusting for debt, this goes up even more, $192.95 to $292.59. With a margin of safety of 5, 10, and 15%, this puts me between the ranges of $164.01 to $278. So according to my discounted free cash flow calculator, guys, this is still looking like an all-out buy. Dear Lord, oh my God. And again, we get the exact same kind of answer when it comes to the PE. It's only 10.21. So as it currently stands, guys, obviously this is not financial advice. Please do your own due diligence. Please read their financial statements. Please also take a look at their earnings report, their 10K, etc, etc, etc. Because at the end of the day, it's not financial advice, and every investment is the present value of all future cash flow. I'm putting these numbers. That doesn't mean that this will happen. When it comes to oil, guess what? All of these numbers will change in accordance to what oil does. And let me actually show you guys something else. If we remove all assumptions, the current price that you should buy this company at would be at $150.24. So again, it really just all depends as to what you believe this company will go to in the future. That's why I give this out all for free, guys. All of these calculators are for free because I want you guys to be making your own assumptions. Now, earlier in the video, I did say Chevron was my best performer. And you're probably like, okay, I mean, when did you buy it, right? Why is it your best performer? Well, here it is, guys. When it comes to Chevron, I hold 123 shares with a cost basis of $12,508. That's essentially how much I paid for this company. And if we take a look at the gains and losses, guys, I am up on Chevron $9,564.23 on a percentage that is a 76.5% increase, which means, guys, that my average share price, it is $12,508, right, which is my cost basis. We divide that by the quantity of shares that I have, 123. I bought this company, guys, at $101.69 at an average share price. That is the reason why I am up almost 76.5% on this company alone. And that's why it is my biggest gainer. You can see that everything else, you got Rio Tinto next coming in at 43.91, right? Merck 41.86, and it just goes down from there. It's a massive jump from Rio all the way up to Chevron. So it really just goes to show as to what kind of price you pay for a company. And by the way, I did not buy this thing at 52-week lows, or at least all-time lows, because as you can see right here, Chevron fell to a low of around $55 in March 17, 2020. So imagine if I would have bought at around like this 55, or if anybody bought at around $55 mark, at around this $55 mark, you would be up so much money today. It's not even funny. In fact, if you would have bought at that $55 all-time low, if you would have bought 123 shares of this company, guys, you would be up right now $15,375. Absolutely insane. So again, it really just depends as to how much, guys, you pay for a company. At the end of the day, the more you pay for something, the less returns you are going to get. And that is the entire thing of this channel, is to find great companies that are undervalued in accordance to the market and buy them at that point. And based off of their fundamentals, if they continue to grow, you would be paying so much less than when they're actually popular, they're actually skyrocketing. And then at that point, it's already too late to buy. And now you're just gathering all the rewards because you did your due diligence and you bought them at a really cheap price when they weren't wanted. So I just showed you guys my portfolio, specifically Chevron, to show off, but to show you that when you buy a company at a really good valuation, you're going to get a lot of benefit from it. So let's actually take a look at this company now in regards to a dividend, because in accordance to discounted free cash flow, this is looking like a buy. Putting in $5,725 at the current share price, this nets you $192.70 in annual dividends, which is actually not too shabby. And not to mention that they are buying back $75 billion worth of shares, that means that that payout ratio is going to come down. Therefore, the chances of them continuing to increase this dividend is a lot higher in the future too. All in all, guys, when it comes to Chevron, there is a reason why this company is my favorite. Now, I personally am not buying anymore because my average share price is just so incredibly low that I see it as a detriment buying it now. But if this thing were to fall back down to like $100 or so, oh my god, you could 100% know I will continue to buy back this company a lot more. That pretty much does it for this video, buddy. Like if you like, comment, subscribe. It really does help her with the algorithm on YouTube. You guys can follow us on the new 6 sites, link in the description below. So with that said, peace out, and I will see you all in the next earnings report analysis as well as stock analysis video.